So, the first emotion we'll discuss in depth is greed. This can be described as an intense and sometimes selfish desire for something and is often related to wealth, food, or power, something that is arguably is common in financial circles. People can be uh, fooled by greed. They can be have their judgment clouded by greed, I should say. And with that, it can often cloud rational thought and good judgment. Say if you have a plan and you see some sort of trade setup and you enter it and you're starting to get in profit, perhaps your greed will cause you to fail to take profits because you think it's just going to keep going. And even though you know that you should take profits at certain points, and you have these levels, you have these target levels for take profit zones, and you still don't do it. You fail to even put in a stop loss, and you think it's just going to keep going, and it turns out it doesn't, and the trade goes against you, and maybe only a few hours later, now you're in the negative, and you didn't have a stop loss set up, and now you're 5% down, 10% down, and you're stuck in the position. If this sounds like a personal attack, trust me, we've all been there, especially in the beginning. I've personally been there, but having an understanding of this is crucial to overcoming it and really having proper risk management and really growing as a trader and as an investor. Now, more poor decisions that could be made include high risk trades, going into trades that you really should have no business taking. Maybe this is on meme coins or coins that just launched on an exchange. They just were dropped on an exchange and you want to take that trade. These are called high risk trades, and they're high risk for a reason because they're most likely not going to play out. And really just generally the idea of taking on too much risk for the potential reward doesn't really line up. Really, what we want to do is we want to minimize the amount of risk that we take on and maximize the amount of reward that we could take on. That way, we stand to gain much more than what we stand to lose. If you take on these high risk trades, it's more likely that you're going to lose because they are high risk. Inherently, they have a higher probability of not playing out. Another thing could be buying coins from an unvetted project based on rapid price growth, buying these new meme coins, or buying the latest blockchain that just came out and is saying that they have smart contracts. These are all factors that we want to consider, and this is where greed comes in, looking for that next small cap coin and not really realizing that maybe instead of buying that new small cap coin that most likely will fail, maybe you could better focus on coins with better fundamentals and better trade setups. Investing in a project without doing any background or fundamental research. This is a big one for newbies, especially people who are not necessarily doing any research. They're just listening to friends and social media and buying what's the latest craze. Once again, not the best advice for anyone, really. Overstaying in a trade position in an effort to squeeze out more gains. This is similar to the example that we spoke about before, where you've entered in this position and the trade's going your way, but you're overstaying. You're not taking profits. You're not moving your stop loss up to break even or maybe even higher to ensure that you're making profit, and you're thinking it's going to keep going up more and more. And this is a fairly greedy decision to make. Once again, not taking profit or not taking enough profit frequently. Another sign of greed is taking out an over-leveraged trade position. Let's say Bitcoin has been in a downtrend and then all of a sudden has a big fat green candle, and you think this is the time, this is the recovery, this is where we're going to break out. And you take an over-leveraged position, and most likely if you're doing this based off of greed, you haven't done your research and you're already working after the move happened, right? You're entering the move late, and then as a result, you're taking this over leveraged position. You have more to lose because now if you take out this leveraged position, if the trade goes against you, if it reaches a certain level, your entire account could be liquidated. It's not just you being stuck anymore. So even just working with leverage can be a dangerous game in general. Canceling or not having stop losses set up. This is a big one that I hear very frequently from friends and other people who are new to trading in general, not having a stop loss. Please make sure you have stop losses set up. If you're not sure how to have a stop loss set up or where to place it, check out our risk management lesson. But generally, you want to have a stop loss set up on all your trades. And if you have to cancel and move your stop loss around lower and lower to ensure that the trade is still going, the trade idea has already failed at that point, right? Maybe you should just accept that it was a failure and next time look for a better entry. Another thing is entering a position late in a trend after initially missing the setup or the entry position. This is similar to what we were saying about taking out this over leveraged trade position. A lot of people, they see these big green candles and they think, oh, I'm going to enter. This is it. This is the reversal. And maybe they enter this position late after a trend has already played out. They're missing the initial setup and entry. And even worse, they might not necessarily realize they're buying at resistance after a move up and they think it's going to keep going up. They missed that big fat green candle. It's already at the resistance line, indicating that, well, buying is most likely going to slow down because it's at a resistance level. They think, well, it's going to break out. It's going to keep going. So they buy at the top and then a few hours and maybe even days later, the price dumps on them. So really, as you can see, all of these, we could look at these separately, but they all play a role and they all are related and often will play into one another, right? It's not just a one-off thing where we can only look at this in a vacuum, right? In context, they all are factors of greed, and typically when the person is not managing their risk or not managing their emotions, many of these different scenarios can play out at the same time. Next up, let's talk about fear. So fear is the emotion caused by the thought that something is dangerous or a threat. This too can cause a trader to have poor judgment and irrational thought, where it can cause traders to close positions too early. Maybe the price is starting to drop and they get scared, or in reverse, if they have a short position and price is going up and they don't realize, like, well, they have this short position at a key point, they have their stop losses set up, and they close the position because they're getting scared. They're scared of losing out, even if they have done their proper research and they have properly analyzed and have a proper setup and strategy in mind. It also can cause the person to question or doubt their strategy, leading to the point of avoiding entering positions and avoiding taking on risks due to fear of losses, right? Everyone experiences loss, right? The main idea of trading is to be successful is to win more than you lose, and that is done through proper risk management and proper analysis, proper setups, having a sound strategy that's based on technicals and not necessarily on just FOMO buying whenever you see it trending on Twitter. Another thing could include selling investments during price falls solely based on emotional reaction. At this point, you are foregoing any sense of fundamental use value or even technical value. You're just seeing red and you sell without realizing that, let's say we're in some massive uptrend and at some point we have a small dip. You see that red and you're going to sell because price is going down, but you fail to realize in maybe a few hours, maybe in a few days, price will return and continue to move upwards. So this is where we start to see, once again, having a broad understanding of market structure, understanding how the markets are created and how markets are made, and the lack of trusting your strategy, trusting your market analysis can lead you to making these decisions that may not be in the best of what you may want of your results. Now, fear can have a cascading effect where panic selling can spread to other investors, resulting in a mass sell-off similar to a domino-like effect. And this is where we start to see where these sell-offs can have these massive liquidations and these massive spikes down in crypto, right? We've seen Bitcoin drop from like 53K all the way down to like 37 in the span of a 15-minute candle. And this is where we see that fear can have this cascading effect. It's really more pronounced in crypto because in normal, if you look at the New York Stock Exchange, they have these safeguards that halt trading if the stock moves more than like 10% in a given period of time or something like that, right? They can halt trading periodically. In crypto, there's no safeguards, right? The market just goes. So here we see a situation where if there's a mass sell-off, there's no one stopping at key price levels, right, and trying to slow down the bleed out. In crypto, it could have this cascading effect, and we see these massive spikes down. And while they could be seen as moments of extreme greed, they can also be seen as moments of extreme opportunity, depending on the person and if they're able to read the market and properly manage their own emotions, right? They see so much fear in the market, that's a buying opportunity potentially. Now, as fear enters the mind, the level of worry begins to affect the individual's performance, just as similar as we saw in our Archer example. Their skill level never changes, right? They have this understanding of market structure. They understand how to read the indicators and read the charts and read volume, but the amount of worry or anxiety blocks their innate skill from manifesting. They can't focus. They think they lost their skills, and they doubt themselves. And this further doubting of their abilities results in worsening performance over time, because now they can't focus, they're losing track of their strategy, they're losing track of their analysis, and at some point they will fail. So to recap, we want to question, why do people lose money in trading? Well, we look towards greed. Well, greed is an excessive desire for additional profit, in which traders stay longer in profitable trades to earn more profit from it, right? But sometimes we know that we're at a level of resistance. It's not just going to keep up, but the amount of greed can make us think, well, maybe it's just going to keep going up. Maybe this is going to be the breakout, when most likely it's not going to be the breakout. Most likely a price is going to respect that level of resistance and come back down to a level of support. We look towards fear. Fear of losing money is another emotion where traders are too concerned about large losses, so they close their positions early, or maybe they just don't enter the trade at all, even though they know that they have a good setup. They see price come down to some level of support where it has retested in the past, and they think, well, maybe this time it's going to fall through. They ignore the reality that price has held at this level. There's a significant support level, and they think, well, maybe this time it's just going to keep dumping. I can buy lower, and they don't take the chance at all, right? Instead of maybe possibly taking a smaller position just to have some sort of entry, because chances are it might hold, right? There is always a chance that it might fall, but at least if you took that chance and you took that, let's say, 5 times in a row, if 4 out of the 5 times it held and the 5th time it didn't, would that be a success, right? As long as you made more than you lost, then technically it would be a success. We look towards hope here. Hope, fear, and greed often come hand in hand. Traders who are losing positions often delay the realization of loss and wait longer in trade with the hope that they will recover losses. So here we see the idea of hope and just thinking the trade will come back around. And really we should not have hope we should not be thinking of hope, because the reality is if the trade went into a losing position, our stop loss should have triggered, right? So the first mistake in this situation was not having a stop loss. The second mistake is just hoping that things will happen, right? We don't want to hope. We don't want to take a guess, because at that point we're gambling, right? We have set analysis. We have a set idea of the market structure and how to read the price volume. We want to use these things to tell us, or to let the market suggest to us which direction price is going to go. Anxiousness and excitement. When your heart is beating with every tick, it is a sign that your position is too big. You have broken the rule of trade and money management. This is a big one, I find. You really shouldn't be excited when you're in a trade, or anxious. If you're excited and you can't stop looking at the charts, you're overextended, most likely, meaning that your position is too big, maybe your trading account's too big, and maybe you should consider cutting back, right? So let's say, this is relative to anybody, right? It really depends how you are as a person and what that account money means to you, because someone trading 30 grand, that might be, half a year's salary. They can't really afford to lose that, whereas some other people, 30 grand trading is not that big of a deal. And the same thing, whether that's 30 grand or even 5 grand or even $1,000. So if that is still too much, there's no shame in going with an even smaller amount, trading $100, trading $10, right? We're trying to build the skill here. It's not so much about the size of the account and the size of the gains, because the percentages all stay the same. So if we're building the skill and we're building the knowledge, then we could start to scale up and not be affected by anxiousness and excitement. Here's an example of trading psychology playing out in real time on a chart. So let's say we have some sort of trade idea. This is Bitcoin on the 1 hour. So here we see our initial short signals here, right? We had some idea to short the market, right? We see the market comes back up, it produces a low, and then it fails to produce a higher high, right? From this high to this high. Well, this is a sign that, we see this sign, volume is dipping as price comes up to here. Obvious continuation of this downtrend, right? We see some sort of market reversal at this point. We see a sign to short here, but we don't take it because we're waiting for confirmation. That's okay. Price comes down to here, so you missed a big move. You wait for a retracement so you can enter the short trade. Well, price doesn't really retrace, and it doesn't always have to retrace. Ideally, right, we want to see price come back near our trade idea for our entries, but sometimes it doesn't do that. Sometimes it just keeps going, right? And that's just the way markets work. So we're still waiting. Price comes down to here. The retracement comes, but you didn't take it as you think you missed a move, right? So price came down even lower. It finally retraces back up to this point. We still don't take the trade. We think it's moved. We're starting to doubt ourselves and doubt our analysis. We saw that we should have taken some sort of short signal. We didn't take it at the top. It comes down to here. We're waiting for the retracement. It doesn't happen. It finally happens here. We still don't take it. Price drops down even lower to 54K, right? It comes back up. We still didn't take it. We didn't panic. We start to panic, I should say, because we didn't stick to our plan and our rule set, and price dumps. Price falls down to like 42K at this point. You got your trade entry. You had your short position ready at 65K. You didn't take it because you were overwhelmed with your emotions. Finally, you see some sort of retracement and you see a big red candle. You enter the trade, and now it's too late, and price is starting to move against you, and now your trade is underwater, right? The trade has gone against you. You've lost money. And a big part of what played out in that scenario is a lack of focus. When the worries of what has happened and what could happen are gone, true skill can be found in what is left, which is thinking in the present and thinking in the moment, living in the moment. Our skills can only be expressed without restraint when we think in the moment, whether that's trading, whether that's being an athlete, driving a car, any type of performance. And trading is a performance. We want to think in the moment and really let go of the human emotion element that can detrimentally affect our decisions. We're able to choose what we think about and what we focus on when we think in the moment, when we focus on what's going on right now. The less we focus on the actual result, the more we can focus on the process on how to achieve the results we want. And even here, we take a look at trading psychology and what contributes to these different factors. We could take a look at personality and characteristics. Does the person, and this will vary from person to person, we're all different. Does the person have some sort of inclination to gamble or make impulsive decisions? They're probably not going to be a great trader, most likely, because they probably have a lack of self-control, whether that's behavioral biases or that's part of their personality and their mental characteristics. How do they react as well in terms of emotional responses to times of crisis or times of emotional depth, right? Let's say we're in some sort of trade and you need to make a quick decision whether or not you're going to cut your losses now or you're going to just continue to let it ride. Sometimes having strong emotional responses or emotionally based responses can be a detriment in those types of situations. We also see social pressure. This is how the person reacts under pressures from other people, right? If we're trading and within a group of friends or maybe on a trading desk, how you react to how other people are talking to you and maybe even treating you, responding to you during trading situations can have a detrimental effect on how you react in the moment and how you think in the moment.